Financial freedom, something that everyone desires. Being debt-free, having enough savings and money on hand to afford the kind of life we want for ourselves and our families. It entails amassing savings to allow us to retire or pursue the career of our choice without being constrained by a fixed annual paycheck. However, achieving financial freedom through employment alone can be quite difficult. This is also the reason why a lot of people are very interested in generating passive income, and the most efficient way of doing this is through investing. In today's video, we will share with you the top 10 assets that you should invest in at a young age to achieve the affluent life that you desire. Welcome to Thrivetastic. If you're new here, why not hit that subscribe button and join our community? And as always guys, give this video a thumbs up for that YouTube algorithm. 1. Index funds. An index fund is a form of a mutual fund or exchange-traded fund, with a portfolio designed to replicate or track the components of a financial market index, such as the S&P 500 index. So why invest in an index fund? Well, it has numerous advantages. First, low fees. Since the goal of an index fund is to match the performance of a specific market benchmark or index, there is no need for an efficient team of research analysts to help fund managers pick the right stocks, which will lead to low managing costs. Secondly, investing without bias. Index funds follow an automated, regulation-based investment method. This removes human discretion or bias from investment decisions. Third, broad market exposure. When you invest in an index fund, your portfolio is diversified across all sectors. For example, if you choose to invest in the Nifty Index Fund, you will have exposure to 50 stocks distributed over 13 industries, ranging from pharmaceuticals to financial services. Next is that the index fund is easy to manage. Index funds are easier to manage since fund managers do not have to worry about how the stocks in the index are performing in the market. A fund manager only needs to rebalance the portfolio regularly. 2. Real estate. Real estate investors profit from rental revenue, appreciation, and profits generated by property-related economic activity. That is why you can hardly go wrong with real estate. Investing in real estate has a lot of advantages. First is due to its value appreciation and continuous cash flow. Real estate values tend to increase over time, and with a good investment and sharp eye for the opportunity, you can generate a profit when it's time to sell. Rents also tend to rise over time, which can lead to higher cash flow. You can also take advantage of tax breaks and deductions when you operate a real estate business. Generally, you can deduct the reasonable cost of owning, operating, and managing property, and since the cost of buying and improving an investment property can be depreciated over its useful life, you benefit from decades of deductions that help you lower your tax income. However, if you're not able to invest directly in the real estate market, there are other options available. There are several crowdfunding platforms where you can invest as little as $500. The money invested would then be collectively invested into real estate properties together with other investors. These investments are known as REITs, or Real Estate Investment Trusts. 3. Education. According to statistics, your 20s are the optimum age to study, and your 20s and early 30s are the best ages to learn new things. They say education is a lifelong currency. It will not depreciate and will not disappear. If you want to invest in education, begin by looking for careers that you are familiar with and that can lead you to success. This could also be an excellent opportunity to increase your financial literacy. 4. Startup business. Investing in a business while still young might yield great profits. You don't have to start your own business. You can invest in other people's businesses in exchange for equity in theirs. You could, for example, be an angel investor, which is a great alternative if you know the owner. Your investment could take the form of a convertible note, which means it could become a loan if a certain requirement is reached. Another is to use crowdfunding. There are numerous crowdfunding sites with fantastic startups with a lot of potential. Before investing in a firm, make sure you thoroughly research the owner and understand the company's history. Choose companies with a compelling storyline and owners that have education, experience, or training in the business industry. Working with a venture capital fund is another option. You can start as an accredited investor and work your way up to being a venture capitalist. These funds, however, have a minimum investment amount and strict requirements. 5. Treasury bills. There is no better time to invest in treasury bills than while you are young. Treasury bills are short-term government-guaranteed debt instruments used to fund government spending and control the money supply. Treasury bills are issued in 3 maturities: 90 days, 182 days, and 364 days. The advantage of investing in treasury bills is that there is no risk involved. It is a short-term loan instrument. Therefore, the maturity time is less than a year, and it's very well secured, so there is no risk. 6. Growth stocks and dividend stocks. Being in your 20s and 30s is an excellent time to place risky bets, since you still have time to recover if you lose your money. So investing in stocks is a great way to put some of your money into a high-risk, high-reward venture. Growth stocks are simply those that are predicted to grow at a much faster rate than the industry average. Dividend stocks, on the other hand, are typically stocks of companies that are financially secure and mature, implying that share prices are less volatile than growth stocks. Dividend equities should be included in your portfolio from the beginning. They provide the potential to receive a regular income over a long period of time, providing the firms continue to operate effectively. 7. Exchange-traded funds. Let's take a look at the ETFs, which are comparable to the index funds we discussed earlier. ETFs are similar to index funds in that they are baskets of securities comprising multiple assets such as stocks, bonds, and gold. They trade similarly to stocks in that investors can purchase and sell shares on an exchange. Their adaptability makes them ideal tools for investing in large market sectors like the S&P 500, as well as sectors like technology or health, and even subsectors like social media or robotics. ETFs include the Schwab US Large Cap ETF, the Global X Robotics and Artificial Intelligence ETF, and the iShares Global Clean Energy ETF. 8. Commodities in economics. A commodity is good that the market treats as identical or nearly so regardless of who produced it. There are various options for investing in this. The initial step is to buy various amounts of physical raw materials such as precious metal bullion. Investors can also invest in futures contracts or exchange-traded products that directly track a certain commodity index. These are highly volatile and complex investments that are normally recommended only for experienced investors. Mutual funds that invest in commodity-related firms are another method to obtain exposure to commodities. An oil and gas fund, for example, might invest in equities issued by companies involved in energy exploration, refining, storage, and distribution. The benefits of commodities investing include portfolio diversity, possible returns, and an inflation hedge. Furthermore, commodities have performed the best during inflationary periods, making them one of the finest investments to own. 9. Annuities. An annuity is a contract between you and an insurance company in which the firm agrees to provide you periodic payments, either now or in the future. An annuity can be purchased with a single payment or a series of payments known as premiums. Some annuity arrangements allow you to save for retirement. Others can help you turn your money into a retirement income stream. Others, though, do both. You have a deferred annuity if you use an annuity as a savings vehicle and the insurance company delays your payout to the future. If, on the other hand, you use the annuity to generate retirement income and your payment starts shortly, you have an immediate annuity. Fixed and variable annuities are the two most frequent types of annuities. There is also a hybrid known as indexed annuity, sometimes known as an equity index annuity or a fixed index annuity. Annuities are frequently products considered by investors when planning for retirement. Therefore, it pays to understand them. They are also frequently offered as tax-deferred savings vehicles. Annuities, on the other hand, have a variety of costs and expenses, including surrender charges, mortality and expense risk charges, and administrative fees. Annuities can potentially carry significant commissions up to 7% or more. 10. Cryptocurrencies and initial coin offerings. Only recently have cryptocurrencies and initial coin offerings piqued the curiosity of traditional Main Street investors. With billions of dollars raised in the ICO financings and over 1,000 distinct cryptocurrencies currently available, these volatile markets are appealing to investors. Most individual investors find it difficult to understand these complicated investment products and identify their risk levels. What we do know is that they have extremely high returns. The returns could vary from 12% to 200%. Some ICOs have done exceptionally well. The OTA, for example, received a 13,000-fold return on investment. That is, if you had invested $1 when it was available, would have made $13,000. When it comes to investment, the earlier you start, the better. The cost will be a lot lower and you will still have some time to recover in case you lose your money. And for investments that earn interest, when you start early, the greater the income you'll generate. So, if you're watching this video and you are in your 20s and early 30s, it wouldn't hurt to learn more about investments and start your journey toward financial freedom. Thank you for watching this Thrivetastic video. So if you found it valuable, consider subscribing to our channel and joining our awesome community. And if you're still hungry for more, we handpicked this awesome Thrivetastic video for you to watch next.